Hello and welcome to another 30-Minute Thursday. My name is Amit. It is 2 p.m. in the glorious, very summery, very wonderful Pacific Northwest. We are live on Facebook. I hope everybody's staying healthy, staying safe, staying sane, of course, and enjoying a beautiful summer. I cannot tell you how fabulous it is to be in the Pacific Northwest for the summertime. It is just overwhelming with things to do. We were at a live concert in the park yesterday evening with friends. Today we're going to an office party for my wife. Tomorrow we'll be hosting a barbecue. Yes, there will be beef and there will probably be bourbon as well. Saturday, we're going to a party at a friend's place. I mean, it is just action-packed here in the Pacific Northwest, and not for nothing, but we also have a huge festival called Seafair that's happening this weekend, and we got the Blue Angels performing aerial acrobatics as part of that. Now, I'm working from the office today as opposed to from home, and so you will not hear them flying overhead here, but at my home, they fly overhead, and it is so cool to watch them come in. They come in hot. They're doing their practice training right now, today and tomorrow, and then on Saturday and Sunday they're going to be performing their aerial acrobatics, and it's just so cool. I love aviation. I think it's awesome, and like I said, I just love being in Seattle, especially in the summertime. We pay for it the rest of the year. 9 months out of the year, it's rainy, it's gloomy, it's cold, it's gray. But summer is just off the hook awesome. So here we are, doing a little bit of work, doing a little bit of leisure as well. People try to get as much as they can of that summertime fun while it's here. So in any event, I want to jump in and talk about what I promoted earlier today about, let me get myself comfortable here, good grief, what I promoted earlier today about the US credit rating being downgraded by a company called Fitch. There are 3 companies internationally that create all sorts of credit ratings. Fitch is one of them, Standard & Poor is one of them, and Moody's is the third. And just a couple of days ago, the company known as Fitch downgraded the US credit rating from AAA, which is the highest you can get, to AA+. So 1 notch down from the best credit out there. And, frankly, that's a really big deal. That is not something to be looked at lightly. It's not something to just be like, what are you going to do? Shrugged off. It is a big deal. And it's going to have a lot of impact on everything that we deal with economically, both nationwide, on the fight for inflation, on our national economy, and also on mortgage interest rates, as well as the residential real estate purchasing process in general. So this is a huge thing. And there are things that happen in this world. There are things that happen that we're not completely prepared for, right? We call it variable change. It comes out of left field sometimes, and it just hits us straight in the head when we're not expecting it. And this is one of those things that happened. I don't know anyone that expected it, but it landed on us a couple, 3 days ago, earlier this week. And let me just tell you why Fitch thinks that the US does not have the best credit any longer. And the reason has to do with our government and the reckless spending that we have been doing as a nation, as a government, as long as I can remember, as long as I've been politically aware, as long as I've been alive. Basically, we have had real budgetary problems, and we continue to kick that can down the road and pass that on to the next person and the next person. Now, I don't talk about politics here, and I don't really care who you like and who you don't like as a politician. In my opinion, they're all equally culpable and guilty of kind of putting this burden on us and on future generations. Now, we can have our discussions about the propriety of some of the debt that we've gone into or some of the spending that our government has done. That's not really my place or my point. I'm just saying that in general, like in our lives personally, in the big picture and in the totality of spending, at some point, the bill comes due. At some point, you're going to have to pay off those credit cards, or you're going to have to pay off the meal that you just had, or you're going to have to give your kids the allowance that they earned, or whatever it is, right? You can't just keep passing that down the road and paying it later and paying it later. At some point it comes due. Well, this is coming due, and I don't know how our government's going to pay for the, massive, massive debt that we have accrued, but I will tell you that they're continuing to just pass that down the road. Well, Fitch looked at it and said, hey, no, you can pass it down the road as much as you want, but we're going to look at this and we're going to treat you differently now, because you're getting to a point where this is becoming unsustainable debt. So right now, we're at a point where our national debt is somewhere in the order of like 118% greater than our gross domestic product. And that's what Fitch was looking at when they said, hey, look, at some point, like you owe more than you can produce to pay it off. In order for most countries to continue to have the AAA rating, the top gold rating that Fitch issues, they have to have debt at 39% or less of their gross domestic product. And we're at like 118% and climbing. And so they made a change in our rating, and that's going to have ramifications and implications. What does that mean exactly? Well, what it will mean, we're still digesting all of it, but one of the things that is likely to happen is our cost to borrow money as a country is going to continue to increase. Now, we're spending roughly $1 trillion a year just to pay the interest on what we owe as a country. That's $1 trillion a year. Now, the federal government takes in roughly $4 trillion a year in tax revenue. And so we're already spending a quarter of that just to float our debt, not pay it down, not pay it off, just tread water, interest only. And that's going to continue to go up. So the cost to the United States to borrow more money, and we borrow a lot of money, that cost on future debt is going to be higher and higher and higher. And that's going to cause some real problems at some point for our country. Just like you've got a budget and I've got a budget, the government should have a budget. They certainly don't respect it, or they don't pay attention to it very much. But at some point, they're going to have to start making some really difficult choices. If you were the creditor to the United States, if you were holding all of that debt, and you see that the US has a lower credit score basically than it did last year or last week, then any future debt that you extend to the US, or credit, I should say, that you extend to the US, you're going to ask for higher interest rates because it's a more risky loan. And that happens, by the way, when I do mortgage lending for somebody, right? If you've got top tier credit, you're going to have better interest rates, lower interest rates, more accommodating interest rates than if you have less good credit or bad credit. And the same thing happens at the global and national level as well. And here we are, the United States, seeing a credit downgrade, and it's going to end up costing all of us more money. Now, again, I'm not here to bash any particular politician, any particular political party. I think they're all equally guilty in this regard. But at some point, right, I'm here to bash all politicians because this is their job. Government does not make money. Government takes money from you and I, and they spend it on whatever it is that they claim the voters want. That's a really hard thing to parse out and whatnot. But fact of the matter is, it's not their money, it's our money. And they're spending it recklessly. And we are seeing and we're experiencing really tough financial sledding right now as a result of some of these choices and some of these outcomes. And that is going to continue. So I don't know where this takes us. I don't know where we go from here with regard to our credit rating and how that impacts. But I will say that the markets have not been fond of this. And the bond market, which is where we get our interest rates from basically, and how the interest rates are created, has been selling off over the last few days because of the credit rating in addition to other things. And so that means that as the bond market sells off, interest rates go up. Bonds are really kind of a backward looking thing. So let me try to give you 30,000 foot explanation of this without getting too technical and, blowing out everybody's wiring here. So basically, a bond is nothing more than an IOU. Whether it's a mortgage bond or a treasury bond, which is what the US government sells in order to finance our massive debt, it is nothing more than an IOU. IOU, trillions of dollars at whatever interest rate paid over the next 7 years, 10 years, whatever it is. When you do a mortgage, it's typically a 30-year commitment, right? So IOU, $500,000 at 7.5% interest paid over the next 30 years. Okay, that is an IOU, and that IOU has value. Investors buy that and clip coupons, meaning they're expecting to get monthly payments from the debtor, from the person, the borrower in this case, at 7.5% interest until that debt is paid in full. That's how IOUs work. Sadly, our government, as I was saying earlier, they have kind of misplaced part of that process. They do really well borrowing. They're not doing great paying it back. But in the mortgage world, you pay your mortgage back, or the bank takes the house in foreclosure, right? So if I've got an IOU that is for $500,000 and suddenly my IOU is worth more. Let's say someone is willing to pay a premium for that IOU, and I sell that IOU for $1 million as just an example. Then that 7.5% interest goes down, because 7.5% interest on $500,000 is not nearly the same. It's basically easy math. It's 3.75% interest on $1 million. And so as the cost of the bond goes up, the interest rate that it yields goes down. And these are instruments that are traded in real time through institutions and other things. So their value changes. Now, the interest rate in and of itself does not change, because that's sealed, right? It's an IOU for $500,000 at 7.5% paid over 30 years. But because the value of it has gone down, the effective interest rate that next buyer is purchasing is going to be lower. I hope that makes sense. Assuming that it does, let me do the reverse for you as well. If the price or the value of that IOU goes down, the cost of it goes down, the interest that it pays is going to go up, the effective interest. The interest rate itself does not change, because it's a deal, it's a handshake, a signature, and a promise. So you're still paying 7.5% interest in this case, but if the value of that IOU goes down to, say, $250,000, it goes down by half, then effectively the interest that you're getting on that IOU at $250 has just doubled. And so this is a really simple example and really simple math. I'm trying to keep it because I don't have slides, I don't have other things. But basically, as companies and institutions buy and sell mortgage-backed securities, which is a bundle of mortgages that we originate and then sell to Fannie Mae and Freddie Mac, and then Fannie and Freddie sell them to these investors on the open market. As the cost of these things goes down, the interest rate goes up. And that's what we're dealing with right now. It has been a very, very tough market for interest rates. If you've watched me, if you've paid attention at all to anything else that's going on around you, you know that interest rates have gone basically straight up over the last 12, 15, 18 months since 2022. And they are going to continue to do this as long as the rate of inflation continues to be high. Now, last Friday, we had some great inflationary numbers. The personal consumption expenditure report for the month of June came out. PCE, personal consumption expenditure, is the Fed's favorite measure of inflation. This is the one metric that they really look at more than any other metrics for capturing inflation. And it's showing that the rate of inflation is coming down. That's awesome. That's fantastic. We want to see that. That's been the goal of the Fed, raising their short-term interest rates as aggressively as they have over the last since March of 2022. I mean, that 15 months, 14 months, something like that. So it's working in that capacity. But we're not feeling anything yet, because we've got all this other stuff happening, such as the ratings change by Fitch on United States debt. And so that is creating a lot of turbulence and a lot of volatility in the markets. And because things are shaky, we're seeing the stock market finally starting to sell off. I say finally because there's been an expectation that with all the inflation and everything else, we should have seen changes in the stock market already. Well, we're starting to see that. I don't know, 2-3 days does not necessarily make a trend, but certainly it's a data point. We're also seeing mortgage interest rates continue to go up and continue to go up. And that is uncomfortable for me as a mortgage lender, of course, for my clients who are looking to buy homes and who are shopping right now, and for my real estate partners who are trying to help their clients buy homes, and they're having a hard time kind of getting everything organized because the rates keep changing, the rates keep going up, and that's not fun. That's not good for anybody. So I'm not trying to be glib about that. I'm not trying to smile about that. Of course, it's better to smile than to cry, but it's a weird sort of time in the markets. And so one of the things, hold on, let me check my time. Oh, we're good. Man, I'm getting through this material quickly today. One of the things that is happening in the mortgage space right now, in addition to the interest rates going up, is something known as points. Points are being charged by lenders to facilitate mortgages for our clients. And it's almost impossible to find a mortgage right now without some amount of points being charged to deliver that interest rate. And I want to spend a little bit of time explaining this to people because it's unusual to have this situation. And I'm going to kind of take a little bit of time to go through it. So what are points? A point, 1 point, is nothing more, nothing less than 1% of the loan amount. So going back to our example, if you have a $500,000 loan amount, 1 point is $5,000. And it is collected at closing as part of a buyer's funds required to close. So when you close your purchase transaction in this market, you're going to have your down payment, of course, however much that is. You're going to have your closing costs, third-party closing costs like an appraisal, title insurance, escrow services, etc. You're also going to have your prepaid expenses, which would include things like your property insurance policy for protecting the collateral in case, heaven forbid, there's a fire or weather-related damage or things like that. So you'll have that premium paid up front for the first year of home ownership. And now you're also going to see points. All that bundled together is what we call funds required to close. So why are lenders charging points right now? And why is this the new normal, so to speak? Well, it goes back to what I was saying earlier about these IOUs and the buying and selling of them. So let me take a step back and kind of give you a little revisit how the mortgage process works and how this ends later on. So you guys work with me, I'm the originator. So I work with you at the very beginning. You get the mortgage, you get the keys to your home, you move in, you hang the art, you're happy, you just make your payments and everything's good. But my company has your IOU for, in our example, $500,000, $500,000 loan. We take that IOU and we sell it most likely to Fannie Mae or Freddie Mac, sometimes to the FHA, Federal Housing Authority, sometimes to the VA, the Veterans Administration, and sometimes to private investors who basically operate the same way. I won't bore you with all those details, but we take that IOU and we sell it to those institutions, to those investors, and we sell it for a premium. Okay, that's where my salary comes from. I don't get a salary, but that's where my commissions come from. That's where the overhead to pay for this office and to pay for this computer that I'm on and to pay for our processors and our underwriters and everything else, that's where that comes from. We sell our IOUs, your IOU basically, to Fannie Mae for a premium. And why does Fannie Mae pay a premium for this? Well, because there is an implied value to being able to collect interest over a certain period of time. Now, most of our loans are done for 30 years, and I don't know too many people who have paid a mortgage off in full within that 30-year period of time, other than by selling the home or refinancing the mortgage. And if you refinance, you're basically starting that clock all over again. Most people in today's day and age don't pay off the mortgage like they did many, many decades ago. So, but there is an implied value to the investors for collecting interest over the next however many long period of time they calculate you and I are going to hold our loans. So let me again come back to our example. So I do your loan, you get the keys, I got your IOU, I sell that, or my company sells that to Fannie Mae. Fannie Mae bundles up a bunch of these IOUs and they sell them to investors. These are large investors. Think about like your 401k, your IRA, your retirement accounts. Sometimes you're investing in stocks, but then as you get older and you're starting to think about actually retiring and living on that income, you are going to shift most likely out of riskier stocks and into more stable, what's known as securities, right? Debt instruments like bonds. And those bonds are going to pay a monthly interest. And that is what you're going to use to pay your bills, to live your life, and to enjoy your retirement. Okay, so these investors are incredibly savvy about actuarial tables. They know very, very clearly how long they can expect to hold your IOU before you either sell the home or refinance the mortgage. And it's that span of time that it's because of that span of time, I should say, that they're willing to pay a premium for your IOU because they expect to collect interest over the next 4 or 5 years. That's how it's been in the past. For the last 20 plus years that I've been doing mortgage lending, the actuarial tables were very, very clear, and they suggested that most people, on average, bell curve distribution, on average, people hold their mortgages for about 4.5 to 5 years. So we're talking about 54 to 60 months worth of interest payments. And so the investors that buy these IOUs can calculate exactly how much return on their investment they're expecting to generate based on these actuarial tables. And it's a good enough investment for them that they are willing to pay the premium up front to buy the mortgage, to buy the IOU and collect interest plus principal, of course, but to collect interest for the next 5 years. Well, they're not expecting us to hold mortgage interest rate or mortgage notes, IOUs at 7.5%. They're not expecting anyone to stay in that IOU for any longer than they absolutely have to. And so the expectation is that we're going to see refinancing happen a lot sooner than the 5-year actuarial table that we were once working with. And because of that, these investors are saying, look, we're just not paying the same premium for this debt because we're not expecting to hold it long enough to recapture our investment, our premium plus our investment. We know that it's going to be paid off sooner. And as a result of that, they're pushing back to the loan originators and companies like mine and every one of the other companies that are my rival companies, our colleague companies, whether it's a bank or an independent mortgage bank like what New American Funding is. They're all pushing back and saying, y'all have got to charge up front in order to get the premiums that you need. And so now we're seeing points, and there's nobody willing to buy mortgages right now at par. Par means without points, without that extra fee. Nobody's buying that right now because the expectation is that we're going to see refinancing happen relatively soon. So definitely within the next 5 years, I hope, but hopefully much sooner than that, right? Hopefully like in the next year or 12 months, 18 months, somewhere like that. I'm not 100% sure when it's going to happen. It's going to take longer than we would have liked. And that is frustrating. It's frustrating to me. It's frustrating to my clients, the home buyers, and it's frustrating to people who are paying a lot higher rate of interest than they were prepared to pay or that their friends who bought 2 years ago are paying. That's a really tough situation to find ourselves in. And again, I put the blame, if you want to call it that, squarely on the shoulders of the United States government in total, as well as the Federal Reserve Board. Hold on one second, let me take a look. All right, we got 5 minutes. So I'll just finish it up by saying it's our government, that is causing this situation. The government sets what's known as fiscal policy. That is the budget. The government decides, the federal government in total. I'm not your favorite politician, not my favorite politician, not my least favorite, your most hated. None of them, all of them together do this. So it's not one particular party or person, but they've all been guilty of doing this. They set a budget, and that is called fiscal policy. They determine how much money they're going to spend and where they're going to spend it every year. The Fed, the Federal Reserve Board, sets monetary policy. They determine how we're going to pay for this kind of, for this budget. And they're both culpable. They're both guilty of basically going down a road where we're spending way more than we take in, and it's basically like, financing your lifestyle on your credit cards. At some point, the bill has to be paid. At some point, you cannot call up Visa and ask if they'll accept American Express for the minimum monthly payment in order to keep floating and keep treading water. At some point, you're actually going to have to make that payment. And our government has avoided this. I'm in my 50s. As long as I can remember, the government has avoided doing this. So at some point, it's going to come due. In the meantime, that burden is falling squarely on your shoulders, my shoulders, our future generations' shoulders. It's just irresponsible, and it's not fair, and it's starting to stink, and it's starting to sting as well. As things continue to evolve, as things continue to go, we're going to see the cost of money rising. Well, as the cost of borrowing money by the government rises, guess what? They're not going to be able to spend as much on other things, roads, healthcare, defense, whatever it is, Social Security, et cetera, because more and more of our government's budget is going to have to go to paying the interest on what the government owes. And it's going to continue to snowball. So I don't know what the answer is. I don't know who is brave enough politically to actually step up and say, no more debt. We've got to pay off what we owe. We've got to get our financial house in order, and we're going to have to make some tough choices. You do that personally. I've done that personally. I continue to do that personally. Most of us live within a budget. Even if we spend more than we'd like to on certain things, that means that we have to cut back on other things. This is reality. Our government and our politicians live in a fantasy land. And while that's fine for them, at some point, it's going to hit really hard on all of us. And that's starting to come apart. I don't know what's going to happen next. There's a saying about, how things evolve, and it's typically slowly at first and then very suddenly. And we've been hemorrhaging and overspending a lot of money for a long time, slowly at first, and then all of a sudden something could happen suddenly. And I am hoping that that's not the case, but at the same time, I am aware of what's going on. I pay attention to the financial markets. I know what's going on within our government, and at some point, I think that things are going to come home to roost. So try to keep things as positive as I can. I can't really, I don't know what else to say, but I do know that we're coming up to the end of our time today. And so I want to thank you guys for taking 30 minutes to hang out with me. If you are in the Pacific Northwest, go out and enjoy yourselves. It's glorious out here, as you well know. If you're not in the Pacific Northwest, come join us. Enjoy a few days or a week or two in this beautiful summer weather, but don't expect that this is forever, because things do change come autumn. It will get rainy, it will get cold, it will get gray and gloomy, and a lot of people find that to be very surprising. In any event, I hope you guys have a great weekend. I hope you guys stay safe, stay healthy, stay sane in a very strange world. And I hope to see you guys next week on another 30-Minute Thursday. Until then, y'all take care, and thanks again for joining me. Bye-bye.